Why don't professional institutional investors like to buy gold? Let me tell you. Hello everyone. This is Brown's Wealth Management Watchtower. I am committed to building a visionary watchtower for you so that you can identify your direction and move forward steadily in a complex and changing investment environment. What is the main advantage of gold as an investment asset? Its price is almost always negatively correlated with other risky assets. Although there is a lot of discussion, it is still a safe haven asset. This correlation is very important in investment portfolios. Even if the correlation is zero, it is still a very good asset that can diversify risks. At the same time, considering its large trading volume and good liquidity, it is very suitable for doing some moderate risk hedging. However, I have to say that if we look at it from a proportional perspective, professional investment institutions are very averse to buying gold. It is understood that more than 80% of investment institutions never touch gold, and even if they do, most of them only allocate less than 5% as an asset hedge. Moreover, they basically keep it there when they buy such a good thing as gold. Why don't professional investors buy it? The first problem with gold investment, as I mentioned before, is that its price volatility is too high, or you can simply understand it as too high investment risk. We know that financial investment is actually a balance between risk and return. The higher the assets, the higher the expected returns I will demand from you. If you see that the volatility of gold is higher than the value of the stock market, then investors should consider it. In the long run, can the expected return provided by gold be higher than that of stocks? That's difficult. Therefore, from a mathematical perspective, investing a large amount of assets in gold in the long run is not the best way. Note that there are two key words in the sentence just now. One is long-term and the other is a large amount. In fact, if you buy a little, such as 5% gold, to reduce the risk of your asset portfolio, it can completely offset some of the risk. It is even very good. However, if you invest a lot in gold, it will actually increase the risk of your investment portfolio. Most institutional investors who heavily invest in gold are short-term traders. In other words, they buy low and sell high for speculation, or temporarily allocate their investment in gold. For professional investors, the second major issue is that it is too difficult to quantify. Just look at my previous analysis of the short-term main factors driving gold prices. Speculation and hedging cannot rely solely on data. Where the reasonable position of gold prices should rise, they may go beyond the reasonable range and buy. Institutional investors cannot analyze it, and the only thing they can do is to look at some very basic numbers. Today, I have shown you some information about who the central bank is buying, which exchanges trading volume, and so on. There may not be much to analyze about these other aspects, and the expertise that these investors have accumulated through hard work may not be useful when it comes to gold. And I'm telling you, it's because gold is difficult to quantify. For fund managers, even if they personally enjoy investing in gold, it's difficult for them to allocate a large amount. Why? Because it's not easy to explain. Think about it. If you're a fund manager and you help clients manage their money, if you lose money by heavily investing in gold and investors ask, all you can say is that I thought everyone might panic. I thought inflation expectations might lead to a decrease in gold prices, and I thought a number wouldn't come out. Isn't that like a fool? If you invest in stocks and bonds, you can analyze something, right? Conversely, if you make money by investing in gold, you still won't look bad. Investors will think that I spent such a high management fee on you to manage my money, and I definitely hope you can pick out some star stocks to outperform the stock market. When it comes to gold, it's okay. Everyone can't understand it. At least we can ensure fairness. When an asset has so many influencing factors, and each of them is almost impossible to quantify, you don't have to worry about it. The key is that you don't have to worry about it. If you feel there are no other better investments, buy some gold. If you want to have better investments, sell gold and buy star stocks. This is actually what I think for most retail investors. The essence of gold trading is not to worry too much, to follow your heart. Of course, when following your heart, I have a few points to remind everyone. This is also something I mentioned many times in 2 videos. The fluctuation of gold price is not smaller than that of stocks, and you need to be mentally prepared for it. Firstly, the cycle of gold is very long. If you buy it to preserve its value, you need to stand at a scale of more than 10 years to achieve it. However, during this 10 years, it may double or even cut in half. Secondly, the transaction cost of physical gold is relatively high, usually 5% to 20%. Therefore, when buying, you need to have a clear idea in mind, so it is not recommended to buy too many. Don't put all your eggs in one basket. Finally, it is recommended not to trust the technical analysis in those institutions too much. As I talked about the supply and demand of gold today, the supply of gold is now very stable. The former king was South Africa, and the demand mainly includes jewelry, official investment, private investment, and others. In the short term, the gold price is very stable. The huge fluctuations are due to love and speculation in gold, which is why gold has skyrocketed, and the reasons why professional institutions don't like to buy gold. That's all for this issue. If you have any questions, you can communicate in the comment section. If you are struggling with investment and financial management in your daily life, you can follow me with your fingers and give you different perspectives to plan your investment and financial management, making your life more comfortable. See you in the next issue.